What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Trayton DeVore. In each episode, you'll hear us break down financial topics that are relevant to the lives of millennials and other young professionals. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
Thomas Kopelman and Trayton DeVore are the co-founders and financial planners at All Street Wealth. All opinions expressed by Thomas and Trayton are solely their own and do not reflect the opinions of All Street Wealth. This podcast is for educational, informational, and entertainment purposes only. It should not be considered advice. Please consult with your financial advisor, tax, legal, and any other advisors you have before making any decisions regarding your financial plan.
All right, what's up, and welcome back, everyone, to another episode of the Long Game Podcast. Today, I am joined by Rubin Miller. He is the founder and CIO at Peltoma Capital, and we're actually going to get into the story behind it because it's all over his website. Really cool story, and we're actually going to switch it up, not talk as much financial planning and talk more investment planning, which I'm really excited about. So, Rubin, thanks for joining me today, man.
Thank you, Thomas.
So let's just kind of start with a quick little story of who you are and then go into the story of, the name of your firm. And obviously you just launched this year, but sounds like things are going really well.
Yeah. Thank you. I started my career back in 2006. I moved to Chicago and I took a job as a bond trader. I lasted 7 years in that world, which is almost like a long tenure that it's kind of like people burn out pretty quickly there. I enjoyed it. I learned to love markets. I love interest rates and bonds and stuff, which I know a lot of people don't. But I entered that part of the industry just as things were shifting from the pits, which you see in the movies with people yelling, buy and sell and making weird hand signals, onto screens. So I spent those 7 years almost entirely on the screens, and I just kind of burnt out. Feels a lot like you're just playing a video game for your career.
For sure.
So I moved away from that. I started to go back to business school. I moved out to California. While in business school, I knew I'd go back to investments. I didn't know how. I did a quick internship at an active managed mutual fund company, Capital Group, American Funds.
Oh yeah.
And then came back to my second year of business school and kind of realized I don't really think about markets that way. I don't really see the advantage of trying to outguess the rest of all the investors in the world and pick stocks. So I said that to one of my professors, and she said to me, you should go find a job at Dimensional. And I'd never heard of Dimensional Fund Advisors at the time. And I found a way to kind of wiggle some serendipity and luck and all that. And I was able to land a job out of business school there. I worked there for 7 years. Then I went to go work at an RIA. And then about a year into that job, it was going well. And I said, there's no reason to sort of do this for someone else. I'll go hang my own shingle. And so I launched Peltoma back in April this year.
Amazing.
It comes from, the word Peltoma is a lake and region in Eastern Canada. And it's my favorite story in personal finance, which is enough that I named my firm after it. And there was basically in the early 1600s, there was these French proselytizers and invaders that landed on this land and were mingling with the Indians and whatnot. And were trying to convince this tribe called the Mi'kmaq that they should adopt their lifestyle. And the Mi'kmaq were kind of pushing back, like, your lifestyle looks awful. You're constantly just gossiping and talking behind people's back. You don't seem that happy. And all you do is sort of chase this idea of wealth and possessions and treasures. And what really stuck with this guy, Pierre Viard, who was sort of the head of these Frenchmen, was one of the Mi'kmaq leaders kept saying, you're not rich. You're not rich. You think you're rich, but you're not rich. And his comment was, we're the rich ones because we have ease, comfort, and time. So this idea of ease, comfort, and time is sort of a thread through, my website, but also like for a reason, because it's the way that I work with clients. Like that is our pursuit, is to make your life a little bit better. And I made the decision I didn't want to call it Mi'kmaq wealth management or Mi'kmaq capital. So I found a sort of a landmark in that area that seemed to have a cool consonance. And so I named it Peltoma.
I love that. That's actually such a cool story. And it's got to be fun at least to explain that.
The hard part for me is, as you can probably tell, it takes me 2 minutes to like get it out like that. So at a cocktail party, I have to be a little more brief and concise with it. But yeah, it's I like being able to immediately tie the value proposition to something deeper than I'm going to try to get you this percentage of returns each year, because frankly, I'm not. That's not really
Yeah.
the expectations I'm trying to set with people.
Yeah. Such a cool story, man. And I love Dimensional. We use Dimensional in a lot of our portfolios. Do you guys still use Dimensional?
Yeah, sure. So I'm a huge advocate and fan, I would say, of that type of investing, like evidence-based, low cost. We are clients of Dimensional, huge advocate for the way they do things. I'm obviously very familiar with it as well. And they're an incredible fund company, I think, for any advisor to have a relationship with, simply because they are so educational in nature, and they do a great job of hiring people. So I really loved working there, and I love being a client now as well.
Yeah. Well, cool. Obviously, we brought you on because you're knowledgeable in the investment space, and that's what we're going to talk about today. So I think where I really want to start this conversation is just kind of talking about interest rates, where they're at, and really how they impact millennial investors. Everything we look at in this podcast is really for accumulators. I think the way that interest rates impact people in retirement is very different than the way interest rates impact people in their 30s and 40s who are accumulators. So I'd love to kind of hear your thoughts on, that side of things.
Well, yeah, fantastic. I mean, in some ways, we'll start our conversation here. And in another way, I'll say most people shouldn't start their investment process here, because interest rates that's the bedrock of risk. That's the only place in investing where we have a risk-free rate, which is the rate on a treasury bond, right? And that's the only thing in investing, no matter what else somebody tries to sell you on. That's the only thing that's risk-free. So what you can earn on that investment, or your yield on a treasury bill or a treasury bond, is critical to understanding or contextualizing what you should expect from any type of investment experience that does have risk. So, for example, in the news lately has been that the 10-year bond, 10-year government treasury bond, now is yielding 5%, or last week it hit 5%. It's a little bit below now, I think. Okay, so what does that mean? It means if you're willing to give $100, you can get a 5% return on that every year for 10 years. Almost 100% guaranteed. There's a little bit of noise based on some of the income you get through the way, but all for what any millennial investor should know is you basically get 5% return for 10 years if you're willing to lock it up for 10 years. What we learned from Silicon Valley Bank scenario was that even in risk-free investments, you, the investor, can become the risk. If you need your money before 10 years, I'm not promising you anything, because prices can go down and you can say, oh, I need liquidity, I need to get out. You're not going to get your principal back. Bonds mature at par, but they have to mature for you to get it back. And if you need it before they mature, there's no promises anywhere on that. So
I think that's something that people forget about, though, right? Like they just think that, like, oh, I'm putting my money into T-bills, right? I'm going to get this, 5%. Awesome. But most people aren't going to hold them to maturity. Most young people are probably not holding them to maturity. And all of a sudden they're like, oh, great. Like, I want to sell this, but if interest rates are higher, that might not be as good of an opportunity to do anything with it.
You got it. I mean, I think that one thing I feel very strongly about, I'd be interested if this resonates with you, but on the equity side of someone's portfolio, so when they build their stocks, almost everyone should own stocks for the same reason, which is long-term growth of the portfolio. We're going to beat inflation. We're going to appreciate with the economy. We're going to embrace the fact that capitalism has always found a way to generate wealth for investors. And I'm going to get super excited about owning a little bit of every stock across the whole world. Like, I get super jazzed about that. At the same time, an 80-year-old who has a lot of short-term liabilities, take the classic 80-year-old widow, worried about money, all these concerns, like probably going to own a lot of bonds, not as many stocks, probably. And then take a 25-year-old, whole life ahead of them, killing it, having a good time. Those people should have the same stock portfolios. I know that sounds crazy to people, but there's no reason to deviate on the equity side. It's for whatever percentage of that is, it's for long-term growth. It's just the fact that the 80-year-old's probably going to have a lot less of it. Not that what's in there should be different, right?
That's what I was going to say. The percentages obviously should be entirely different. But I also think this is to me, this is where investing starts, is the mindset around it. Because I think, when I was in college or, right after college, like the friends that I talked to were like, oh, Apple's down 10%, I'm going to buy Apple so it can go up 20%. So next year I can sell and I can do this. And it's like, you don't understand that investing, like you don't really win in investing by 1 year returns. People think that they do, and they think that's the goal, when in reality, you're making the game way harder than it needs to be versus like looking at, I mean, look at the S&P 500, right? Like there's never been a 20-year period of time where the S&P 500 was down. And when you play the game that way, I think things open up. I mean, I feel like when you're in your 20s and 30s, you're making a good amount of money and you spend all this time trying to optimize, like finding that one right investment. Typically, you're way better off instead of spending all that time there, just like becoming better at some skill that's going to grow your income, because that is going to yield you way more than getting an investment that was 20% versus 10% on $10,000.
All of investing is just a distribution of likely future outcomes. And when someone goes to pick a stock like Apple you're describing, it's not that it's not going to work out for them. I happen to work for this couple, and they both work at Apple. They worked there for a long time. They have a lot of stock that vested that wasn't sold. A lot of their net worth is in Apple, and I have been chipping away at that basically since I started as an advisor almost a couple of years ago. They aligned with me on that our goal is to reduce some of this risk. But I told them early on, like, it is very possible that you will be wealthier if you ignore all of my guidance. It's just what Apple's going to do. It might go to the moon and beat the tar out of the S&P and small caps and blah, blah, blah. And your wealth, backward looking, was better off without my help. That said, what happens in the future is just what happens in the future. It doesn't tell us anything about what could have happened in the future. And my job is to make sure that we take this distribution of outcomes, which is very, very wide if you own one stock or a handful of stocks, and start bringing it in a little bit and providing you more clarity around our expected outcomes together. But if I don't set expectations that, you might look back and say, gosh, darn it, stinking Rubin had us sell that Apple and it went up 30%. We have to be very aligned that it can also go down 30%. Yeah. And this is why we're doing that. So for me, when I think about the equity side and the diversification story, which I think you and I align on, it's that I have so much information around the data you provided around, there's no negative 20-year S&P rolling returns or whatever the data you cited is. I know that if I buy the global economy, historically, it's been very resilient. I have no reason to believe I'm not going to get a nice return in the future if I hang on for a long time. If I buy one stock, I have no idea how I'm going to do. And I also know that a bunch of companies have gone bankrupt in the past. I don't like that payoff structure if I'm a financial planner trying to provide people clarity around outcomes.
Yeah.
So, yeah, go ahead.
I was just going to say, it's like you look at BlackBerry or some of these other companies that were like at the top, nobody could ever see anybody taking over. And then all of a sudden they do, right? Like the likelihood that Apple is the best company 50 years from now is a lot lower than Apple probably is still the best company 50 years from now. So when do you move out of that? Yeah. That becomes the really hard part. But again, like I work with a lot of the similar clients like you. And I think, in the situations where you both work at a company or even separate, you both work at really great companies, you have lots of equity compensation, all the indexes are really comprised of that investment that you have. There is a big conversation to be had there, right? Like I'm not the traditional financial planner that says like never hold more than 10% of that. Like that might be CFP textbook. It might be like, let's figure out what the right percentage for you is, right? Like somebody who's in their 30s and their 5 million net worth could have way more Apple stock than somebody who's, made a lot of bad decisions, has high debt, not a lot of other investments. And then the other side of it is that couple you're talking about, it could be entirely different whether they have more stock coming in the future, right? If you have a lot of RSUs being granted to you that are going to vest over the next 4 years, you might say, well, hey, let's diversify, but not through any of the stock that we have now, unless we're going to like donate to a donor advised fund. Let's diversify through all future RSUs, right? Or ESPP and sell right when it's due, or, et cetera. But people don't think about how to diversify. I get a lot of people who said their financial advisor said, sell all of it. It's like, you have all this coming in RSUs. Why would you sell all of this and get capital gains? Like it really makes no sense. Both sides, you get the appreciation potential of the future.
It's a lot easier for advisors to have somebody come aboard and just sell everything and start fresh. Of course, we shouldn't do that. It's not in the client's best interest, but it's a lot easier way to run your business, to stick clients with a tax bill and move on. I want to go to where we were. So we were on a thread about stocks versus bonds, and then back to interest rates. So I was kind of making this parallel that like what people don't realize is that this 85-year-old widow and this 25-year-old or whatever, they actually should, if you have my philosophy, which is like evidence-based, low cost, don't try to outguess other market participants. There's a lot of smart people in the world. You don't need to
Globally
fight
diversified.
them. Sorry?
Globally diversified.
Globally diversified. So I want clients to look something like the world.
Yeah.
You know, which in broad strokes looks something like 60% in the US and 30% international developed and 10% emerging markets. Those are very round numbers. Thankfully, you don't have to be precise on this stuff. You just want to look something like the world.
Yeah.
And that's your stock portfolio. When it comes to bonds and the interest rate conversation we're having, man, not even two 40-year-olds that live on the same block in the same town in the same state, they may even have similar jobs, are going to have the same bond portfolio. Almost always you have different concerns and preferences and liabilities in your life that you're going to deviate, because that's what bonds are for. That's what interest rates do for you when you build that side of the portfolio. Inflation risk, interest rate risk, you know, use muni bonds for tax preferences. You might have liabilities in the future. You want to, your kid's getting married in 10 years. You want to buy a treasury bond that's going to match that liability because you want to have this amount. All this precision you can get from bonds. You don't get any of that crap in stocks. Stocks is for growth. You're going to put it in there. You might do some rebalancing, but you're going to let it go. And so what matters, as you shared earlier, is the weight you own of these risky and less risky things. But on the stock side, I can help someone build a stock portfolio in 3 minutes. I don't know how much of it they should own, but I can tell them how to think about how to build a globally diversified, low-cost portfolio. On the bond side, that's a lifelong evolution. You're changing that your whole life. Obviously, it matters less when you're 25 because you own probably less bonds. But as you get older, that life cycle is super critical to make sure you have some precision. And thankfully, the last 2 years have taught everyone this. The bond index, the Barclays Ag, is down something like 17% over, from its high. People didn't expect that. That wasn't the expectation we had, but that was reality. And if people weren't prepared for that, obviously they're like, okay, I need to know a little bit about bonds now.
Yeah, that's interesting. I think most people don't really think of that. Like I have an interesting, maybe I'd say an interesting relationship with bonds in the way that like I view a lot of younger people having no need for bonds unless they have a lower risk tolerance. Like I personally own 0 bonds. 0% of my portfolio is allocated to bonds. But I would say, for one, I'm really young. I'm under 30 years old. I have a high risk tolerance. I am probably very far ahead financially compared to what I would be just between the valuation of the business that I built that, is already sellable and, the net worth and the income that I have. And in this interest rate environment, for, let's say I bought a house, right? Like I'm buying a house, I'm going to have an 8% mortgage. I think I personally would rather allocate dollars to pay down my 8% mortgage than I probably would to allocate to bonds personally. But I also have a lot of clients that we do have bonds. I have older clients. Like I have a household I'm working with now. They're mid 40s. They could retire today. They're, $9 million net worth. They're going to have a lot of bonds. And for me, then it's also about, I think the hard part sometimes is like, I want to have the right bond allocation, but I also want to have the right bond location. And so I want these bonds inside of these 401ks or these, it's easier with IRAs, obviously, but a lot of times I have clients with huge 401ks. They're 5 to 10 years away from retirement. We're going to hold 10 to 20% of bonds. I want them to be there, but they don't have good bond choices.
Yeah, I'd love to talk more about asset location on bonds. One thing I just want to say is bonds are all about providing predictability, right? Mm-hmm. And I'm talking about investment grade bonds. People that go play the junk game, that's kind of a different type of investing. I'd almost put that more with stocks than I would with bonds. You're kind of guessing on the future of a company. And if they happen to remain solvent, you get a payday. But that's not the game I want to play in as a financial planner first, But your life you just described, one of the arguments why someone like you may not own bonds is what you just shared is you already have a lot of predictability. You have consistent cash flows to your business. You have a good line of sight on how that's going to look in the next few years. And your life as a business owner is a lot more predictable than putting all your money in equities. So at the very least, you could say, I do have some bond-like exposures already in my life.
True.
Where I've seen changes in the last couple of years is our expected outcomes or our expected return as investors equals the expected return on our risky assets times our weight of risky assets plus our expected return on safe assets times the weight we have in safe assets. So if we just use stocks and bonds to keep it simple, and we expect to earn, let's say, 9% in stocks and 4% in bonds, and we're going to be in a 60-40, then it's 9% times 60% times 4% times 40%. And that equals
like
our expected
7%.
return. What?
So that's like 7% in that situation.
Okay, so let's call it 7%.
Yeah.
The difference for people today compared to 3 years ago, or even 2 years ago when rates started to go up, is the bond portfolio expected return used to be like 1%, right? That was the yield that you would get. And for people that aren't as familiar with some of this, on an investment grade bond fund, your yield is your expected return. On stocks, there's no yield that's helpful on stocks. So you kind of want to use historical data to help inform what you expect. The average is, you want to say maybe between 8 and 10% on average for a globally diversified portfolio. We could be conservative, say 8 or 9 or something like that. But it's this equation that matters. As you described, your equation gets a little bit more confusing because you say, well, I have this other bond-like stuff, which might make me less inclined to own actual bonds and more likely to put some more money over in stocks. But for everybody in the last couple of years, this parentheses of my expected return from bonds has gone from 0 or 1 to 4, 5, or 6, right? So you should need less weight in stocks to accomplish your goals, since a part of your portfolio now, you have high predictability around getting a higher realized return, that expecting and then hoping to realize it. And it's not just before inflation, it's real interest rates, right? It's after inflation, interest rates have gone up a lot. So the equation has changed. And I would say the big takeaway would be someone that used to want to be in a 90-10 portfolio because they're super young may actually want to be in like an 85-15 instead now, if you want to kind of retain the same expected return.
Yeah. Yeah. I like your philosophy on the bonds for matching goals. Like, to me, that's how I really think of it. Cause I think sometimes, well, I guess oftentimes people use bonds as stability to your portfolio as a use for behavioral reasons, right? Like, hey, if I have these bonds, when the market drops, the 60-40 portfolio is going to drop by less, which means that person's probably going to sell less, right? Like, that is a core philosophy I think a lot of advisors talk about. What I found is actually younger generations' risk tolerances are significantly higher.
Yeah.
Like, I was just talking about this last week with Adam Nash, who he's like a professor at Stanford. You know, he was the CEO of Wealthfront, like all of these great things. And he was like, oh, I haven't really thought about that. But like, most of my clients have rid through crypto, or, you know, they held Peloton and Etsy and, you know, these other, you know, big companies that have dropped, and none of them sold. Right. And honestly, a lot of my clients, they don't even view their investments. And so for me, I'm like, I'm using bonds for time. Like, right. Like, if we're going to 3 years from now, you're going to buy a house. Like, I have a client who they're going to go to Hawaii for a couple of years because of a PhD program, and they're going to come back and buy. That's a great time for me to do that. But for other people that have high risk tolerance, I'm not like, oh, let me throw you 20 or 30% bonds because I think that you might sell, because I've been working with you for long enough to know that you don't actually even know if the market's down. Like, it doesn't even matter to you. You're focusing on all the right inputs. You're investing in the right globally diversified portfolio. We're going to add bonds down the line for when that fits. And I have other clients who they do need some bonds, and you do have to coach them through the behavioral side of things. And that's, to me, where it starts to make sense, is behavioral reasons for the right people or matching time frame with goals.
Totally. I also, one of the benefits it provides you is you now have these 2 different asset classes. So if stocks get whacked, you know, you're going to say, oh, great, that worked out for me, you know, backward looking. I'm not saying it was the right decision, but it worked out. And then you have the chance to sell some of your bonds. If they've stayed strong, they're higher, rebalance back into stocks. But if you're not willing to do that as an investor, then there's a lot less argument to have that element of diversification. The rebalancing factor is a benefit to owning multiple asset classes, whether it's Bitcoin and equity and bonds, or just equity and bonds. The more asset classes you have that move in different ways, if you decide these are the weights I'm going to own them in, rebalancing is an incredible opportunity to buy some stuff high, buy some stuff low, and sell some stuff high when you get those chances. If you're not going to do it, there's less an argument to really introduce that at all. And I think, as you described, these days, certainly there is an opportunity cost to just your clients that are in Hawaii that want to buy a house in 3 years to just holding all that in cash in a bank account. So I think it's helping clients realize, how do treasury bills work and risk-free investments work? What's my expected outcome? And how could we design and implement a solution for that? What I love about treasury bills is that your expectation is going to match your reality. That's what risk-free investments do. And investing, the world of investing, the history of investing is so full of all these stories of people who think they're going to get something and they don't get it, where expectations don't match reality. So to the very first kind of part of our conversation, I love talking about interest rates first, talking about risk-free rates first, because it's the only time where you guarantee that your expectations are going to match reality. That's a really helpful financial planning input, even if you don't use them. Because you say, well, maybe I don't want to buy treasury bills. I want to buy Bitcoin and I want to buy the S&P 500. Okay, well, you better expect a higher return than treasury bills. Otherwise, why would you ever take that risk?
Yeah, 100%.
Right. So you help contextualize, what should I expect and what's this wider distribution of outcomes I'm willing to embrace? Because if I just go buy treasury bills, there's not a distribution of outcomes. I know my outcome.
Yeah. So this has been awesome so far. So what would you say is like the takeaway for millennials right now with interest rates and how they impact them?
So the most immediate, tangible, and I think accessible concept is stop giving banks your return. Don't let these intermediaries hijack what you deserve. And what you deserve right now is at least the risk-free rate. So there's definitely a trade-off between implementation frictions, like a high yield savings account, which is also risk-free, by the way, up to a certain amount. A high yield savings account might yield 5%, and let's say a risk-free treasury bill yields 5.5%.
Yep.
But you love that bank and you love using that bank and you don't really want to go deal with the headache of treasury bills. I don't have a problem with that, because it's like you understand the possibilities and you said, I land on the 5%. Where I get gutted is when I talk to someone who didn't know risk-free rates are at 5.5%, have hundreds of thousands of dollars in a bank account for the last 2 years, and just no one ever helped them design and implement a plan to go capture the $10,000 or $15,000 that should be theirs every year in income. So find a plan to make sure that whatever dry powder you have, you're optimizing. Optimizing doesn't have to mean the highest yield. I think, frictions and basically hassle matter, but be comfortable with the options and then choose one and then go. Then I think what you said earlier is spot on, which is just that we need to lay out our goals. And for you, these goals are very long-term. You already kind of have a predictable bucket in your business and the way your cash flows work within your business. Someone like you might say, I really don't need that many of these bond things. I already have a lot of predictability or enough predictability for me. But that's going to be different for everyone, which is kind of earlier why I said I was using, I think, older people as an example, but two 29-year-olds, some gal that lives down the street from you in Carmel, and you guys have similar, maybe she has even a similar business, but your bonds portfolios are going to look way different. Maybe she has a different risk tolerance, different preferences, different tax bracket, whatever it might be. So that part's going to look a lot different. I think it helps to work with a planner to help you decide what that bond portfolio should look like to match all those liabilities. As I said, I also feel very strongly it's the opposite on the equity side. You and that gal should probably have very similar equity portfolios, in my opinion.
Yeah, agreed. Okay, cool. I feel like we hit on that really well. I have a couple questions that I want to ask, as we wrap up. One of them would be what advice do you have for millennials on designing their equity side of their portfolio? And this could be things that you already said, but I like to just kind of end with some takeaways that people can.
So you and I both know, because we're both familiar with Dimensional, that there's a lot of research about what drives expected returns. It's not just the expected return of a basket of global stocks. There are different types of stocks. There are small stocks and there are large stocks. There are stocks that make a lot of profits and there are stocks that don't make a lot of profits. And there's these various data cuts you can take. A lot of our industry has veered toward really, really caring about that kind of stuff. I take a step back and I say, look, I think there's a lot of smart people out in the world buying and selling stocks every day. By the way, I feel the same way about crypto. If you ask me about Bitcoin, I would say, the price is probably fair. A lot of smart people that trade Bitcoin. So It might not mean I want it, or maybe it means I want a lot of it, but I just think the price is probably fair. I feel that way about stocks. So then people say, well, there's a premium for owning different types of stocks. And the most famous ones are small stocks and value stocks, or what they call low price stocks, right? So small cap stocks are smaller companies. The explicit market cap, the actual price to buy the whole company, is lower than a large cap stock. And with value, it would be called relative price, because your price for some metric about the business is lower than some other stock. And if you buy small or low price stocks, that you've done better over time. And historically, that would be true. At the same time, I say, well, how much better should I expect if prices work pretty well? So I don't, it's not that I don't care about that research. I care a lot about that research, and it further reinforces how I'd like to design portfolios, which is with that information in mind, but not going too far into it, because the same people that discovered that research or put that all together are the same people who are going to tell you that prices are fair. So I try not to deviate too much from the market portfolio. So when I build and design a client portfolio, I would encourage someone, as we talked about earlier, like look something like the world. And the biggest problem I see, not the biggest problem I see, one of the problems I see is investors don't know what drives their returns. So you can either decide that returns come from the market or returns come from a manager. And we were raised, and our society 20 years ago basically lived on this fact that we think returns come from a manager. I find someone smart, I give them my money, and they go buy the right stocks. All of the data tells us that's wrong. We give them our money, they charge us high fees, and they're not very good at picking stocks. That's a more reliable outcome, to be honest. So I don't really want my returns to come from a manager, because I know that if I just bought a stock portfolio of a little bit of every stock across the world, I can target my 8 to 10% expected return. That's a super helpful financial planning input, right? As we're building these lives out for your clients, 5, 10, 15, 20, for your clients, maybe 30 plus years in the future, 8 to 10% return is huge. So I always say, I don't want anyone to hijack that from me. I can get it at a low cost. I can remove idiosyncratic risk by designing diversified portfolios. Why would I let somebody charge me a high fee and concentrate my portfolio, build a wider distribution of outcomes, and possibly outperform? There's not a chance I want that.
Yeah. I couldn't have said any of that any better myself. The one thing I do want to hit on is like the globally diversified portfolio that mirrors the market, because I think that people don't really realize that they're taking a calculated bet by doing something different than that, right? I think some people think that you're taking a bet that US won't win by having a globally diversified portfolio, but I actually think it's the opposite. I think that you're actually taking a bet on US if you don't have a globally diversified portfolio that mirrors the market. And it's probably the most common thing I see. And then people are like, well, that means that they did better than the portfolio you'd have over the last 10 years. And I'd say, sure. But if you look over the last 120 years, typically US and international switch off times pretty close to equal times of outperformance, right? We are in the longest historic time of US outperformance relative to the global market. So to me, it even makes more sense to being like, I need to have international in my portfolio, knowing that and knowing where we're at today.
One of the hardest things is allowing us to assess our outcomes based on the quality of our decisions rather than the return itself, right? The realized return. And if you have a well-calibrated expected return, it doesn't mean you made an error if international underperforms the US, as you described. It's about a trade-off through time. I like to look at it in decades. And, you know, in the 70s, international did much better. In the 2000s, international trounced US or the S&P 500. You want to sign up for an investment experience where you can think about it in decades, and you don't want to be wrong for a whole decade. So I find no reason to think I'm smart enough to outguess everyone else in the world. Everyone else sets prices together. This is what we've done together. That's the equilibrium, the price. Who am I to outguess that? So I want to look something like the world. What I did want to say was, one thing that's happened is that large companies across the world tend to be multinational, right? So Nestle or Toyota might be an international company, but have a lot of a national company in that country, but have a lot of impact and ramifications for global portfolios. They do business all over the world. Same thing with Apple or Coca-Cola in the US. So one thing to be aware of is if you really want to have a globally diversified portfolio, it is very likely that you want to deviate from the market cap weights. Like, I don't want my my portfolio of Japanese stocks to have 70% Toyota. I don't think it would be that, but have some huge amount of Toyota when Toyota doesn't actually really represent that economy. It represents the globe because they're doing business all over the globe. I wrote this blog on my blog this summer. My wife and I spent a month in Italy, and I went around and looked at all these small cap Italian stocks. And they all reflect the Italian economy and culture and heritage of that country. That is a diversified return stream because I have exposure to the Italian economy. If I go buy Ferrari stock, that's not the Italian economy. That's a global economy of rich people that are getting drunk and gambling in Vegas and winning and going to buy Ferraris. So I do think that it's very sensible if you build a global portfolio to not just get large cap indices, which are cheap and available and not bad, but you're not going to get the levels of diversification you get if you get into the small caps and micro caps in these countries. We're talking about dimensional early. They do an incredible job because they're a passive philosophy investor, but they don't track an index. So they can they can buy the smallest companies in various countries. Like, I think about that less in terms of the small cap premium, which we talked about a little bit earlier, and more about, I just want to be as diversified as possible and own these incredibly innovative parts of the world. And you don't get that if you only own large multinational companies.
Definitely. And I always hear that argument from people too, is like, well, all these big companies are international, so why would I hold international? I hold these companies. It's like, it's actually more of a reason, if you think about it, to then buy the international ones. If you think you can get those companies from the international, wouldn't you buy the discounted international indexes and funds to grab that?
Yeah, I see very few reasons not to globally diversify. I think it starts from having a philosophy around prices, right? If you think that because you live in the US and you're familiar with these companies and you have all these biases and that leads you to want to keep owning US, fine. I just don't think that's a very thoughtfully designed portfolio or philosophy. Whereas if you think that, wow, look at all these people that trade every day and they're smart and they have PhDs and CFA charter holders and blah, 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 blah. You're like, all right, I'm just going to accept that price or fair. And as you shared earlier, like, focus on more impactful things I can do with my time related to planning and tax. It's a huge weight off an investor's shoulders to embrace a passive philosophy. You get to stop worrying about a bunch of crap that you shouldn't be worrying about anyway. And all the data tells you that you shouldn't worry about it.
I love it. That's like the perfect way to, I think, end this podcast talking about investing. Rubin, man, I really appreciate you coming on. Let everybody know best places to follow, engage with your content, and read your blog.
Oh, sure. Thanks. Yeah. So I write a blog called Fortunes and Frictions. It's just fortunesandfrictions.com. You can subscribe there. I am on Twitter, Rubin J Miller, and I also post content on LinkedIn. You can find me there, and I look forward to connecting.
Amazing. Well, everybody, thank you for listening. Please rate, subscribe, and we will see you back next week.
Thanks, Thomas. Enjoyed it.